My name is Graham Bird. I'm the fund manager on Gresham House Strategic and in fact run our strategic public equity strategy at Gresham House. Actually, to answer the confusion about Gresham House and the funds that we manage, I thought I'd just give you a very quick overview of Gresham House as a business. Gresham House is an alternative asset manager. We manage assets under two broad strategies, real assets and equity, which we call strategic equity. They are alternative strategies, so you won't find mainstream equity funds sitting in here. They're all specialists focused on specific niches where we think that we can create excess value. Within real assets, that's easier to talk through, there are really three main subsectors. We have a forestry business where it's all UK forestry and there are funds investing in forestry. We have some renewable energy funds, so solar and wind funds, and increasingly also more recently we launched a fund called the Energy Storage Fund, which is investing in battery storage solutions. And that's actually from right through commissioning, management and running those battery storage facilities. And then there is also a division within Gresham House which does housing and infrastructure. That's all small scale infrastructure, tends to be alongside local authority pension schemes and so on, about social benefits and driving some of the government policy along that. The bit that I'm really involved in is strategic equity. And within that, we have a number of strategies. We have some venture capital and private equity, where some of you may have heard of Barron's Mead, which are venture capital trusts. We manage those. We also have taken over a legacy private equity portfolio called LMS Capital, which is also an investment company, investment trust, which has been in wind down, and we've sort of gradually turning that around and realizing things from there. And then we have a listed equities business with a microcap fund and an income fund. But the bit that I find most interesting, and the bit where I sit, is what we call strategic public equity. And this is a strategy which is a combination between public and private equity investing. We sit in that grey space between public markets and private markets. We take, and I'll tell you a bit more about it in a second, but we take influential stakes in smaller, predominantly quoted UK companies, and we look to help drive change in those businesses through our engagement. So I see this as a separate asset class. It's not a mainstream small cap fund. The average size of company that we're investing in is much smaller. It tends to be under £200 million market cap, where we see significant inefficiencies in the market, and I'll talk a bit more about that as in terms of the market opportunity. So that's what I'm talking about today, is strategic public equity, and that is a investment company quoted on the stock exchange, which you can buy through your broker. So talking a little bit about Gresham House Strategic, if there are a few things I'd like you to remember at the end of this presentation, it's what is interesting about Gresham House Strategic. Well, first thing is you can actually buy at a discount to NAV. This discount was at the end of March. It actually has come in a little since then, so it's a bit below 20%. But gradually we are seeing that discount coming in. We've had some pleasing performance in the last 18 months, and I think if we can continue to do that, that discount will come down. But there is an opportunity to buy at a discount to NAV. We have a very concentrated portfolio. That is our objective. We get engaged with these companies, so typically we won't own more than 15 stocks. And typically I will have a very close relationship with those management teams and be working almost like a private equity investor would, not necessarily sitting on the board, but actually almost acting as a sort of confidant and helping them find the right solutions for their businesses. And that's how we engage. So it is a concentrated portfolio. We have a value bias. So we're looking for companies which we believe are intrinsically undervalued and that we can see how a catalyst might change that valuation. And actually, if you look across the portfolio, which is what I've got here, is that we are the valuation of the portfolio compared to the market, in my mind, is quite compelling at the moment. And this was the end of March. But where the market as a whole, the FTSE small cap as the proxy here, on an enterprise value to sales is valued at 1x sales, whereas within our portfolio, if you're buying at that discount, you're buying a portfolio at 0.6x sales. On an EV/EBITDA basis, the market is at 11.8, whereas our portfolio, again, taking into account the fact that you're buying at a 20% discount, was at 3.5x EBITDA. So you're buying on a compelling valuation argument. And yet the sales growth within our portfolio is actually ahead of the market. So those are based on broker forecasts. So the argument is you're buying at a discount and you're buying a portfolio which itself is valued at a discount. So from a valuation perspective. At the back end of last year, actually in the autumn, we realized a big chunk of IMI Mobile, which had been a big holding which we had, which gave us a significant cash holding. Through the first quarter of this year and actually in the last month, we've been reinvesting that. So we still have just under 8% of cash sitting on the balance sheet. It was as high as 25% at the end of the year, which was timely given the market was weak, and we've been able to invest some of that, I think, in some quite attractive opportunities. This is a strategy which we've been running for over 15 years, not in this fund. This fund we took over back in 2015. We've just had 3-year anniversary in Gresham House Strategic. But Tony Dalwood and I worked together at SVG Capital. He was the pioneer of this sort of investing using private equity techniques in the public markets. We launched a fund back in those days in 2004 and have managed a number of funds, and the performance on those funds has been very good. On average, looking through 3 limited partnerships and 2 closed-ended funds, if you look at the annualized return and compare it to the small cap, on average it's outperformed the small cap by 10.7% per annum. That strategy. So it has its ups and downs, but actually on average over 15 years, that's been a proven strong performance. And I think finally, now is quite an interesting time to be looking at this type of strategy. You've had nearly 10 years of since the financial crisis, and certainly the last, maybe not the last year, but the run up to the last year, you had a very momentum-driven market where things were sort of moving upwards, rising valuations. Actually, value as a style underperformed, but actually we're starting to see that revert to norm. Interestingly, that outperformance of momentum coincided with a period of quantitative easing, money coming into the market and pushing everything up. Actually, we're coming to the end of that, and I strongly believe there is an interesting time to start thinking about whether one looks at some alternative strategies, and perhaps value-based is an interesting place to start looking. So I think those 5 things are really points which I'd like you to remember. You can come in at a discount. You're buying a double discount because it's attractively valued, and that is our style. We've got cash we can go and deploy, and we can make work. We've been doing this for years, and it has outperformed over the long term. This is a longer-term investment, and now is quite an interesting time to look at the market. So what is strategic public equity? As I said, I would like to define this as a separate asset class. It's not small cap investing, because actually we're looking at targeting 15% returns over 3 to 5 year investment horizons. We're investing in undervalued UK and European, largely public companies, but right at the small end of the market where we believe there are inefficiencies in the market. And I'll talk a little bit about the market opportunity in a second. We take influential stakes, so typically 5 to 15% of the company, and are very actively engaged with management, like a private equity investor would be. We don't control the company, but actually working with those management teams to try and help them drive change in the businesses. Because we are operating at a small end where there is not a lot of public market research, we need to do that research and due diligence ourselves. And hence, that results in 2 things. One is we do have a much more concentrated portfolio. There's only so much you can do. But also we need to be investing in high conviction opportunities where we've done the work and we believe we can see what catalysts are required to change the performance of the business. And that then really leads to this a long-term engaged approach and using sort of private equity techniques. So some examples of the types of situations we look at are if we can get involved in primary capital issues, that's usually associated with a catalyst in the company. It's either funding an acquisition or providing working capital to make a change in the way the business is operating, or fixing the balance sheet, which can create stresses and so on. So primary capital issues I like because they do usually come with some sort of catalyst that's going on. You've got to pick the right ones, of course, but that is a good place to get in. It also usually means we can come in at a discount and we can get our influential stake in one go, rather than having to nibble away and perhaps signal to the market that Gresham House Strategic is becoming involved and everyone comes following in. So that's a good place to be. A lot of our success stories are actually in this box, where you are changing the culture of a business. That's usually associated with a change in chairman, not necessarily chief executive. Actually, it's often about the incentive structure. There's some good examples about managements that are incentivized on growing EPS and not necessarily shareholder value. And EPS might be done by making lots and lots of acquisitions, but actually they don't generate their return on capital, and actually you're just drawing value. If you can align incentives around what is going to create value in the company, and change the culture and the way in which the business is run, that often creates significant shareholder appreciation. We can take businesses off the market. Lots of small companies shouldn't be on the market and should come off. We can participate in that. And equally, as an influential shareholder, there are the opportunity to structure attractive deals in pre-IPO situations and follow through into the IPO. So, market opportunity. This, to me, is the most compelling case as to why this is as an asset class is an interesting place to be. We've seen lots of regulatory change in the last 10 years, and not all of that has been beneficial to the small end of the market. It's all well-intentioned, but actually there have been some consequences. And the two things that I would point out is, firstly, MiFID II, which came into effect last year, means that the distribution of research is more restricted than it has been. Now, that's all fine when you're a FTSE 100 company and there are dozens of banks following you. When you're a small cap company, there's typically only one broker following you. And if people aren't buying their research, no one sees the research. They can't distribute it to wealth managers anymore. The wealth managers don't buy the research. So you had a contraction in the distribution of research, not necessarily in the production of research, but certainly in the distribution. And the evidence, certainly on surveys, suggests that that's how the investment community sees it. So less efficiency, less information out there, an advantage to people like us who can do the work on our own. The other thing which has happened is regulations such as the Retail Distribution Review, which happened a number of years ago, which forced institutions to have model portfolios, as the wealth managers and what have you, has meant that many of them have had to move up the market cap scale because they can't get enough shares in a £50 million company to spread across every single portfolio. So fewer people investing in that space, less efficient information in the market, means often you get pricing anomalies which we can capitalize on. So there's a great opportunity to capitalize on that. And this is just an illustration of this. This is the number of companies on the line in different market cap categories and the number of analysts publishing research. So if you're above 5 billion, on average, you've got 20 analysts covering you. If you're below 100 million, you've got 0.6 analysts covering you. So there's the illustration. The other thing is, looking at smaller companies, the valuation anomalies are quite stark. Now, there's reasons for that, illiquidity, etc. But actually, again, I think if you're buying into growing companies, you can buy an attractive price, your longer-term returns are going to be much better. So here's an example. Companies that are larger than £250 million, on average, are trading at just on 10 times EBITDA. If you're under 250 million, you're at 7.8. So there's about a 20% discount for being a small company. And yet the growth rate, if you're above 250 million, your revenue growth is about 7%. And if you're under 250 million, the average growth rate is 22%. So you're buying more growth for a lower price. That's a common small cap argument, but I think particularly that sort of supports what we're doing. The other thing which I mentioned earlier is the value versus growth argument in terms of taking a value approach to things. If you look over the long term, this is a 40-year chart measuring the performance of value style against growth or momentum. And actually, up until this point here, you saw a very strong positive correlation. It goes up and down, but generally value outperforming growth. With two exceptions here, this was the dot-com boom in 2001, where value underperformed and momentum really ran ahead. That corrected itself. And here's the financial crisis. And what's happened for the last 10 years is value has underperformed massively. Well, that's coincided with the greatest quantity of money coming into the markets through quantitative easing. Question mark. We're now 2 standard deviations below the norm. Okay, is this a long-term norm? Has it changed? I think there are reasons to believe why it's underperformed. And actually, as that QE money tap gets turned off or even reverses, are we going to get back to a long-term trend? And I think there's a strong argument that we might. So I think the value versus growth argument at the moment is quite an interesting one. Just in terms of performance, we do invest in businesses where they are going through change, and quite often it takes some time to see that change coming through. We took on the mandate in 2015 in August. We went through 3 years just last year. Our investment horizon is typically 3 to 5 years. And what we saw here is a number of the catalysts in some of our biggest investments starting to come through. And in the last 18 months, the fund has really outperformed quite meaningfully. And that's really been driven by catalysts within the within the specific investments we have. So I think the outlook is positive. The momentum at the moment within the companies that we own is good. So hopefully we can continue to generate that sort of performance. Our process is modeled on a process that you would typically see in a private equity firm. We have an investment committee where we have some external members. They're not there to make the investment decisions. That's my decision. That's my job. But they are there to tell me when I'm being an idiot or to really question whether I've asked all the right questions. And that's very helpful. So having people like Bruce Carnegie-Brown, who's been at 3i, he's now actually the chairman of Lloyd's of London, but who's been through the mill many times, just asking the right questions. Having people like Tom Teichmann, who is an aged venture, seasoned is the wrong word, seasoned is a better word than aged, seasoned investor in venture capital and TMT and so on. Having people like him on that panel is very, very helpful to me. So we go through a process where we have idea generation, which we generate from a number of sources. We have a strong relationship with the small cap brokers. We do quite a lot of our own watch lists. We talk to other investors. We talk to private equity. We watch what private equity is doing. If they're doing loads of transactions in one sector at 8 times and the public market's valued at 6, that's quite an interesting place to look. But there's not many public market investors who actually speak to private equity and see what they're doing. So that is where this crossover mentality works quite well. We do a one-pager on that, a basic financial analysis. Does it look like it might make money? Does it reach our returns? We have a quantitative and a qualitative assessment. The quantitative is we need to see how we can make 15% per annum over that 3 to 5 year period. So over 5 years, can we double our money? That's the simple metric. And we will plug that into a model, and value is created by a combination of 3 things. It's earnings growth, it's re-rating, and it's cash generation. That's how you create value. So if you can buy something on 5 times earnings and sell it on 10, you don't have to double your earnings to double your money. You double your money just on the rating. If you buy something doing £100 of profits and it can go to £200 profits and it's on the same rating, you double your money. Similarly, if the cash generation out the business is 20% per annum, it takes you 5 years to make your money back. So that our model sticks out very clearly where the value creation comes from, and that then informs how are you going to incentivize the management team. What are the catalysts you're looking for in terms of the messages you want to give to people about what you're going to perform, what your targets are, and then making sure that actually they're tracking along the way. We don't always get it right, but it is a disciplined process which at least identifies where the value is going to come from. And that's very much sort of private equity minded. We then go through a preliminary investment report, so detailed financial analysis. We do a qualitative analysis in there, so what's the market like, where does it sit in the market, how good is the management, are they incentivized, are they aligned, is there a deal to do, can I get shares at a discount, can I get the shares at all? Ultimately, who else is going to buy this company? So when I come out, who am I going to sell it to? Is it to the market? Is it to trade? Is it to private equity? I need to know that, because if I'm owning 20% of the business, I can't expect to dribble it out in the market easily. I need to know what is the strategy for getting out. That goes to our investment committee. They typically will come up with a whole lot of more ideas around due diligence. We need to know more about the marketing strategy. We need to do some more detailed due diligence on the supplier. Actually, I know someone in this industry who's done this before. Go and have a word with them. Maybe we should put someone on the board. Go and solve all of those, come back with a final investment recommendation, and then we can go to a full weighting. Now, being in the public markets, we can actually start investing here, so we can build a toehold stake here. Sometimes the share price starts to run ahead and you don't want to miss the opportunity, but it wouldn't be a full weighting until we've done all our work. So 2%, 4% full weighting, if that's what we want. That's basically how it works. Throughout our experience, we've identified really what we call our sort of circle of competence. What are the characteristics which often mean successful deals? And you can't always get all of these characteristics. So this sort of comes back to some of the qualitative criteria I was talking about. But the first thing is, look, can we actually get in at a clever price? Returns, the correlation of good returns and good buying is very, very high. If you can buy at the right price, your chances of making money are just so much better. So hence the sort of value orientation. But also if we can self-originate, which we often do, good examples, Northbridge, which is in there at the moment. Historically, we've done other deals where sometimes the company doesn't actually know they need the money yet. And by forming a relationship with them and working with them and identifying what that strategy is, you put yourself in a very strong position to then say, actually, we can solve your problem. And funny enough, they open the door and actually you get a very engaged and collaborative relationship. So, a good example, last year we did a convertible loan note into Northbridge, which helped them refinance their banking facilities. When we started negotiating, the share price was £1. So I said, look, I'll take a convertible 8% coupon. I've got a second debenture over all of the company assets behind the bank, but I'm a secured creditor. It's paying me 8% coupon, a conversion price at 125. Today the share price is 173. I'm still getting my 8% coupon, and I still have the security over the assets. So from an investment risk perspective, that's a great position to be in. And from the company's perspective, they liked it because at the time, they didn't have to issue shares at a discount. And secondly, the cash flow characteristics of that were much more attractive than the bank was offering. Because the bank would say, yes, we'll give you a term loan, but you need to make repayments every quarter. Whereas my comment was, look, if you perform, you'll never have to repay this, because I'll convert into equity. If you don't perform, you repay at the end of 5 years. It's a bullet repayment. So there's cash management along the way. The second area is identify the investment thesis. So this comes back to, is it value creation through earnings growth, multiple expansion, cash generation, and what are the catalysts which make that happen? So be very clear about what is it that's going to change the perception and the performance of the business. The third area is, can we actually engage? Are the management going to talk to us? Are we going to engage with them? And can we influence things if they start to move off track? And how easily are we going to do that? Because if they do move off track, you need to step in quite early. And sometimes I'm guilty of it. We let things go too long. And actually sometimes you need to step in much sooner than we do. But that is something which we look for. And then finally, this catalyst and the exit is, once things have happened, the value ought to have been generated, and then what do I do and how do I get out? So those are the sort of key characteristics. In terms of the value enhancement, how do we add value to the investments that we make? We talk about being private equity-minded investors. We talk about looking for businesses going through strategic, operational, or other management change. We talk about behaving like private equity investors, which means adding value to the investment. Well, how do we actually do that? And there are a number of areas we can. So, whether it's capital restructuring, so providing capital to fix balance sheets or anything along those sort of lines, or whether it's introducing people as non-execs onto the board, or whether it's providing a sort of role as corporate advisory. These smaller companies typically are under-advised. They're not FTSE 100 companies. You have McKinsey crawling all over them, or JP Morgan, or Merrill Lynch, or any of the other big investment banks. These are smaller companies. They don't engage with the consultants because they're too expensive. They're not looked after by investment banks because they can't make any money. And their brokers are brokers who manage 100 companies and speak to them twice a year when the results come out. So actually being that ear to listen to the chief executive, which can be quite a lonely place, being a chief executive, actually being that engaged shareholder, we find is a very, very valuable piece for our investee companies. And then we have an advisory network. I talked about some of our investment committee members. Those are good examples. But we have a much broader network of industrialists who we engage with, like private equity do. And typically a lot of these people they actually come to us because they can see when there are interesting situations where they might get involved, we can help them do that. So we actually find it's an inward flow of people coming to want to meet us and want to get to know and help us with due diligence and perhaps get engaged in companies. So we can do that quite a lot. And then finally, increasingly we do a lot here, which is around just helping management teams tell their story in a way which is both consistent, clear, and follows a path along this journey that we're going on. And again, smaller companies, they're engaging with the city twice a year. People like me work in the city every day. You assume people understand how the city thinks. They don't. If you're based in a small company up in the Midlands or what have you, you can go to business school. It's not quite the same thing. So we do a lot of work around that and sort of helping companies just tell their story better. So that's that. I'm not going to go through each of the companies here. This was at the end of March. Actually, since then, Tax Systems was taken out by private equity. So again, one of the benefits of the way in which we assess and evaluate our opportunities is because we're looking at things through the lens of private equity. It's no coincidence that a high proportion of companies we invest in land up being taken out by private equity. That's not necessarily because we've made that happen, But actually, if something screens well on a buyout screen and the public markets don't re-rate it, at some point, private equity is going to see the same thing. And if management are frustrated, they're going to go with it. So tax systems is a great example of that. We invested, part of our thesis was it was heavily geared. Public markets don't like gearing. Private equity doesn't mind gearing. But it had a very predictable cash flow. It could quite easily manage the gearing. We could see it paying down the debt quickly, which created a lot of equity value without having to grow the earnings all that quickly. But ultimately, it was a business which, once they started to pay down the debt, you could see an opportunity for private equity to come in and say, we're just going to re-gear it. And we'll take it out. And that's exactly what's happened. So nice premium that we got out on that. IMI Mobile we've held for some time. As I say, we sold out. It became a very big weighting in the fund because it's done very well. We sold a big chunk last year, rebalancing the portfolio. So we're actually a bit more balanced now than this, because Augean and Northbridge are bigger relative to where they were. So we've got a more balanced portfolio. It's a technology business. Interesting catalysts there were more about getting the market to understand the business better and repositioning from what was seen as an emerging market business into a UK and North American business. So that helped the rating, discount for emerging markets, premium for local markets. The chief executive has done a very good job in making acquisitions which have enhanced his position in the UK market, given him the leadership position here. They've gone into the US, very strong cash generation, 90% of their revenue is recurring, 100% of EBITDA turns to cash. They were, so strong cash generator and growing at sort of high teens organically. So where else do you find that sort of thing? Great business, which once we got people to understand it better and cleared up the balance sheet, they had some B shares and what looked like a big dilutive event, which actually was not. You just needed to understand the maths, but that was complicated. So once we got that unwound, suddenly people began to understand it better. I won't go through all of these. We'll run out of time, but some good examples. Northbridge, I mentioned. We came in initially on an equity story, refinanced. They had made some acquisitions at the height of the oil and gas boom in 2015. It's a business which had exposure to oil and gas, and suddenly when revenue fell, they breached their covenants. But fundamentally, they were able to manage their cash flow. It's a rental business. They've got high depreciation, so you go into losses quickly, but actually by stopping the capex, you can manage the cash flow. So they were able to stay positive cash flow throughout all of this period, and yet their earnings, they were showing losses. So market looking at EPS goes, oh my God, they're losing money. They breached some covenants. We were able to get it to know them for about 3 months before we suggested an equity issue, which we underwrote. We came in, we introduced someone to the board. It was about taking cost out of the business and then waiting for the recovery. The recovery took longer to come than we thought. We then helped them refinance their bank facilities through this convertible loan note. And actually this year, they've come out with some very positive statements early on, and the share price has really started to move forward. So that's been a great story. Augean has been a fantastic performer this quarter. This was one with an HMRC question mark. We did quite a lot of diligence around that and what we thought that could do. But fundamentally, it was actually about turning the business around. They sold off loss-making businesses, change of management associated with that. So you can see the catalyst, new strategy, new philosophy, new culture in the business. Going back to those blocks of where does this fit in, that was a cultural change in the business. Take out the loss-making businesses, focus on cash generation, get rid of non-core assets, pay down debt, turn it into cash, shore up the business, and actually the EBITDA has grown massively. They've generated cash, they're now cash positive, and in the meantime, they've been gradually whittling down the HMRC claim. So it's still only a sub 5 times EBITDA. Funny enough, private equity is investing in waste management. Every deal done by private equity has been done at 8 times EBITDA. Look at the ownership structure of this. Okay, the biggest shareholder is Harwood Capital. They have a big private equity business. So, I wouldn't be surprised. I don't know anything I shouldn't know, but I wouldn't be surprised. This is a classic one where I just think if the market doesn't correct the valuation, ultimately it's a sort of takeout target. Anyway, so those are some examples. I'm happy to talk about plenty of them together. Performance I've talked about. These are just over the years we've had a number of funds. The point that I made was that actually if you take the average outperformance per annum, it's been 10.7%, which is a rather pleasing number to be able to quote. The team is really myself, Lawrence Hulse. Tony Dalwood is actually chief executive of Gresham House, but he's very close. This is his baby, so he and I have worked together for 15 years. So he's very closely involved in that. I mentioned Tom Teichman and Bruce Carnegie-Brown. Rupert Robinson was the former chief executive of Schroders Private Wealth. He's now part of Gresham House. He's the MD of Gresham House Asset Management, so he's on that investment committee as well. So that was really all I was going to say. Just to come back to those sort of initial points. This is an investment team with a strong track record and experience in this particular strategy, and we're confident that we can continue to do that. You've got an attractive entry point, certainly in my view, that you can still buy this at a discount. I think in the portfolio, I sleep easy at night at the moment about the performance of the portfolio. I don't think anything has run ahead of itself. They're all attractively valued, and you've seen that by the metrics I showed you. We have a flexible mandate, so being able to do things like convertible loan notes and things gives us an ability to manage that risk-reward ratio very well. I think there's an interesting timing in the market at the moment, the value versus growth argument, the small versus large. We're very aligned. I've got a significant investment in here personally. Gresham House itself owns 20% of the fund, so it really is backing us to make a success of this. We do pay a dividend, and there's a commitment from the board for the next 3 years to grow that dividend by 15% per annum. It's about a 2% yield at the moment. Think about this ultimately as an asset class outside of traditional small cap. It's not, don't put your whole portfolio in it, but actually as a component of a portfolio, I think it's a really interesting space to be. So thank you. I'll take any questions if we've got a few minutes, I think.
I got two questions. One on the slide which shows you've got tax losses of 135 million. I wanted to understand where they came from.
Yeah, so Gresham House Strategic as a company, the entity was actually originally SPARK Ventures. And actually go right, some of you might remember New Media SPARK, which was a fund raised in 1999, and it raised a whole lot of money and invested in .com, and it lost a lot of money in the .com boom, and those tax losses date back to them. We took it over in 2015. It was in a realization phase, and we took it over really as a shell. It had one investment left in it, which was IMI, and so we've inherited those tax losses. So we have capital losses and revenue losses in the business, which we can utilize to our benefit.
And secondly, in the idea generation slide, which is the dominant source of deals for you? How do you generate?
I wouldn't say there is a dominant source, but we do maintain very close relationships with the corporate side of all of the small cap brokers. So what I want is, it's not the salesman phoning me up saying there's a great idea. I want the corporate side phoning me up saying, I've got an interesting company which is going to need some funding in 6 months' time. You need to get to know them. So we get quite a lot through that route, and then also just through, interestingly, through other investors. We have very good relationships, and we maintain relationships with usually larger investment managers who can't get directly involved in some of these smaller things, and they can see a problematic or an interesting situation saying, this needs a bit of a shake-up, or it needs someone to get involved, or there's a great opportunity, I haven't got time to do it. Would you have a look at it? And actually, so we get quite a lot coming in from there.
I can understand why you guys are really good money guys, but I just, whenever you take over a company and you say like the waste management company, and you identify there's a problem with the management, where do you go to find people that you can rely on to sort waste management? Because you know nothing about waste management.
No, that is fair comment. And generally, we're looking for situations where we actually do want to back the existing management team. And quite often that's a case of there has been a management change and there's someone new in there, but the market hasn't yet understood it. That's quite an interesting space. But we do actually have, one of the benefits we have at Gresham House is within our equity piece, we do have a venture capital business, and we have a woman in there called Hazel Cameron, who is head of talent. She is an ex-recruiter. She works for the private equity business in helping identify and find talent. So we can do that. And I talked about this network of advisors and industrialists. They typically more chairman candidates than a chief executive. But that is a source of opportunity. And I think the chairman is probably the most undervalued position in small cap companies. It's a very, very important position because the chairman is the person to whom the chief executive reports. And the chairman is ultimately the person who determines whether the chief executive stays or goes. So by finding the right chairman, you get the right cultural alignment, and actually then either you get the chief executive doing the right thing or that chairman can take that on for you. So that's sort of how we manage it,
Thank you very much indeed.
Okay, well, thank you all.